I'm going to give you a very quick introduction to the hedge fund industry. This is not exhaustive and it's very basic, but it should give you a rough idea of what a hedge fund is and what they do. So we'll start with some basic ideas. Unsurprisingly, one of the basic ideas of a hedge fund is that of hedging, which is a way that you can reduce your overall exposure to the market, and this also allows you to profit under any circumstances. So if the market goes up, you can make money, and if the market goes down, you can make money, which makes hedge funds very attractive, because it's not important whether the market's going up or down. They can profit in both cases. They're very dynamic. They can do a hell of a lot of different things. Got a huge number of things that they can invest in. Coming back to this idea of hedging, you can take long and short positions. A long position is very simple. You just buy a stock or an index or something, you just buy it. A short position is more complicated and involves borrowing and repaying, which allows you to make money as things go down. So you're short if you think something's going to go down, you're long if you think it's going to go up. And they talk about an absolute return, which is, as I said, making money when the market goes up or down. It's always trying to make the return positive regardless of the positions that you've got. A good example is what's called the 130-30 fund. This means that you have 130% of assets long and 30% of assets short. And we'll take an example of $100. So you invest 100% of your capital long. So you just buy $100 worth of stock, which is all if you've raised $100, you buy $100 of stock. Then you sell 30% of your assets, which is $100, so you get $30 and you're short selling. So you have to buy these back later. Hopefully you'll buy them back at a lower price and you'll make money because they're cheaper. So you sell that $30, so you get given $30 for selling stock that you don't yet own, but you have to buy it back, hoping the price goes down, so it's cheaper to buy it back. And then you take the proceeds, the $30 you've got, and buy more shares long. So you've now got this $100 long and this $100 long, and you've got $30 short. So in essence, you've got $160 invested when you only started with $100. You raised $100, now you've got $160 in the market, but your net exposure is $100 because you've got 30 short and 30 long. And if you're a really good stock picker and you can pick the stocks that are going to go up very well, you've got 130% of the assets doing very well, and you've picked stocks that go down, or those that fall. If the market's going to fall, those that are going to fall fastest. This can be an extremely profitable strategy. This can work phenomenally well. But it's of course risky. And to complicate things, not all hedge funds are hedged. It's not... To be a hedge fund, you don't have to hedge. It's... The original funds that A.W. Jones started up were hedged. But some funds call themselves hedge funds, but are not actually hedged. Another key idea in a hedge fund is that of leverage, which is borrowing money to invest. So you can borrow money at the moment at a very low interest rate. Money is very cheap, and you can invest that, and if you're really good, you can easily pay back the debts and profit a lot from the difference between the interest rate you're paying and the gains you're making. But of course, they do want their money back, so it is very risky. These investment banks and brokers are not writing things off. They do want their money back, and if things go wrong, you can be forced into selling things and putting up more collateral in markets where you can't really be doing that. You have to crystallize enormous losses if things go very wrong. The areas that hedge funds typically invest, you have stocks and bonds, long or short positions. You can make bets on commodities, gold, silver, metal, even soya beans, all sorts of things hedge funds can be involved in. Bet on currencies. A lot of what you've probably heard about hedge funds will be about George Soros the bets that he made on currencies. Bet on indexes. You can be long or short in the S&P 500. You can make bets about interest rates and the economy by buying or shorting the US house builders. These are ETF is an exchange traded fund. So it's a fund that owns a collection of stocks in US house builders, and that's traded on a stock exchange. You can buy into maybe 200 companies in one stock. And derivatives, which are things that take their value from another thing. For example, you get options where their value is dependent on the value of a stock. It's a right to buy a stock. Let's look quickly at the derivatives. As I said, stock options, which is the right to buy or sell a stock at a specific price on or within a specific period. Various types of options. So you can. This allows you to put up a little bit of money but control a lot of stock. You can put up thousands and be controlling millions in stock positions. So it's a way of leveraging, but it's very risky because most options expire, so you end up with 100% losses. Futures contract. This is an agreement between two parties to buy or sell something at a specific price in the future. If the price goes up and you've got an agreement to buy it at the lower price, you make money. Other way around, if you have agreed to sell something at a specific price and the price goes down, well, you get to sell it at a higher price than the market price, so you make money that way. Common strategies used. You've got global macro. You'll hear funds described as being macro funds. These look at the entire economy and make decisions and bets. You can bet on currencies, make bets on government bonds. If you think a government's credit rating is going to go down, you could short their bonds. Short entire sectors. The classic example is in 1992. One of probably the most successful hedge fund manager, George Soros, made £1 billion by short selling the British currency, and it's known as Black Wednesday. Event-driven funds, these profit from major events that are happening in the market. The hedge fund manager makes a decision on the outcome or what's going to happen and finds opportunities to profit through that event. You've got bankruptcies, mergers, acquisitions, so on. For example, you could short sell debt in distressed companies. If you thought a company was going to be in real trouble, you take short positions in its debt. You can go through loan books of banks and try and make decisions on what the future of the bank is. You can profit from the difference between stock price and acquisition price. So if you think the company's going to be acquired for a higher price than the stock, for example, RGR and Nabisco, that you had a bidding war between KKR and American Express, and that shot the stock price kept going up and up and up as the higher and higher acquisition bids, that is to take over the company, kept going up. The stock price moved to reflect that, and some people made a lot of money by betting that would happen. Arbitrage. Two prices should be the same. They're not the same. You make bets on that and you make the difference between the price it is and the price it should be. It's in theory very low risk, but these are very hard to come by because usually you have these algorithmic trading. That's one of the things they do, so you've got to be faster than a computer. So these inefficiencies are extremely small. The old way people used to do it, and now the algorithms do, is very small differences between convertible bonds and the underlying stock. That's a bond that will pay interest but can be converted into a stock in a company, and maybe that's trading at a slight discount to the stock, so when it converts you'll make money. Hedge funds are probably most famous for their fee structure, which is pretty high. They are not cheap. Typically you get what's called a 220, which means every year they take 2% of the assets out and 20% of all of the profits go to the hedge fund manager. That's a hell of a lot of money if you're running billions of dollars in a fund. Take this statistic someone came up with in a research paper. Top 25 hedge fund managers earn more than all of the Another advantage of this fee structure, the 220, 2% assets, 20% of profits, is that it's very tax efficient for the managers, because the 20% of profits can often be considered a capital gains, which is taxed at a lower rate. So they can make even more money because they get to keep a higher percentage of what they earn. Though this 20% of profits isn't always guaranteed for the manager. For example, if the fund made 1% and the S&P 500 was up 10%, you'd not be wildly happy. If you were an investor in the fund, you wouldn't be very happy giving 20% of that tiny gain to the fund manager. So usually they put in a hurdle rate, so they'll say it has to earn this much or do this well before this 20% of profits applies. That you get that from reading the documentation behind the hedge fund. And also they carry losses forward, not every fund, so that if it lost lots of money last year, it did very bad, the manager wouldn't be paid that 20% of profits. But even if it made a profit next year, he wouldn't be able to take the profits because he's not really made you any money. He's just made back, say, the losses that he's already made. And I've just got a few books that I'd quite like to recommend. I've read all of these. They're very good. Probably the best book to get you started on hedge funds is More Money Than God, which is quite an adequate description of them. You also got The Greatest Trade Ever. This is an entire book about John Paulson short selling the mortgage-backed securities, which made him enormous amounts of money. His salary the year that he did that is estimated to be about $4.9 billion. He's got the world record for the biggest earnings in 1 year, and that's how he did it. And also, When Genius Failed, this looks at long-term capital management, which blew up spectacularly. They had several Nobel Prize winners in their management team, but yet everything went completely wrong. And it's a really good warning about just how risky hedge funds can be, the use of leverage and derivatives. So hopefully this video has given you an introduction to what hedge funds are, what they invest in, and what they do. And I strongly recommend that you, if you're really interested in this area of finance, that you read some of those books. They are excellent.